What's up everyone, my name is Joris, welcome back. Apparently all that glitters is indeed gold. The price of 1 ounce of gold has this week passed the psychological barrier of $2,000 each. The reason behind this recent rise is the hope of another stimulus by the Democrats and the White House to support the American economy. Investors fear inflation due to the big budgetary deficit and they seek shelter in the gold. The rise in gold, however, is not new. It's been going up for months now. This is due to a few factors. We will look at them right after you've smashed the like button for the YouTube algorithm and if you've subscribed to the channel if you've not done that already. So first off, a cheaper dollar. Gold is priced in dollar. So if the greenback loses value against, let's say, the euro, European investors will buy more gold since it's cheaper for them to invest in it. Another reason being the huge stimulus plans of the worldwide central banks. They force the interests to go down. In Japan and in Europe they're already down for quite some time now, and even in America right now the rates are extremely low. The lower your interest rate, the more interesting gold becomes. Since gold has no interest rate on its own, the difference between the savings accounts and the golds are next to nothing at the moment, making savings account less interesting, favoring gold. Another reason being the global illness going around and the tensions between America and China are very prominent in the news, which makes investors nervous. When investors are nervous, they sell stocks and they buy gold. The global stock market is another one. We had a major crash back in March, but that's not the only reason. Ever since the start of 2019, major investment companies started to get out of the stock market, thinking a crash is imminent. Well, last year the markets went up by 33% and this year they crashed by 40% in March. Major investors were hesitant to get back into the market at the end of March and they missed great opportunities. We had one of the fastest crashes of 40%, but we also had one of the fastest recoveries of 40%. Since the initial rise in March, investors are very hesitant and nervous. They expect the market to drop substantially any minute now. This indicator, the VIX index, shows that the panic on the market has dropped, but the nervousness is still omnipresent. As long as people are unsure about the market, they will seek safety in gold. Now, should you buy gold for your portfolio? I personally do not believe in investing in gold, at least not on my age. It has no capital gains, it provides no dividends, and its price is actually dependent on the volatility of the market and the trust in the stock market. As said before, a lot of factors have an influence on the price of gold, and as a result, gold prices at the moment are on an all-time high. But the second a treatment is found for this global illness, the global economy will be opened again, lockdowns will be lifted, and global transport will resume its normal course. The stock market will follow right after, or it might even anticipate it. Major investors who had stocked up on gold will want to switch back to stocks and bonds. Gold will be sold en masse and prices will go down substantially. A lot of pharmaceutical companies are reaching the final stages of the vaccination development, so we might be getting close to a solution. So personally, I think the gold rally will not last for much longer. But some major banks expect the price to reach $2,400 an ounce or even $3,000. This might be a little bit too optimistic. On the other hand, does gold ever have a place in your portfolio? Yes, it does. Since gold often performs better when stock markets are performing poorly and vice versa, it is a great insurance of your portfolio. 2019 was an exception on this rule, where both stocks and gold went up considerably. If you have accumulated money over your working career and no new money is coming in, having gold in your portfolio makes sure the volatility of your portfolio is reduced. If you need a monthly or yearly income from your investments, gold will make sure that your portfolio does not fluctuate a lot, so your income is safe. A maximum of 10% in gold will be advised in this case. If you are accumulating your portfolio and adding new investments every month or every year after receiving your paycheck, gold has no place in the portfolio. Investments made in this scenario are there for the long term, and stocks will always outperform gold in the long term. If you've liked this video, be sure to leave a like and subscribe to the channel, it helps us a lot. And thank you for watching, and I will see you next time.